Ladies and gentlemen, if there's one truth that every investor will ultimately regret ignoring, it's this: silver isn't just rising, it's breaking free. What we are witnessing right now is not a minor blip. This is a structural shift, a tectonic move in the markets that will go down in history. Today, silver is not merely climbing, it is racing. And if you're not paying attention, you're going to look back years from now and wonder why you didn't act when prices were still affordable. For years, silver was treated like an afterthought. Investors chased tech stocks, cryptocurrencies, meme trades, anything that moved fast and promised easy gains. Meanwhile, silver sat quietly, consolidating, building pressure beneath the surface. But markets have a way of punishing complacency, and what we're seeing right now is not random noise. It's not a short squeeze, it's not retail hype. It's a decisive breakout from a level that capped this market for years. When an asset smashes through long-standing resistance with conviction, that's not coincidence, that's a shift in psychology. Resistance levels exist because sellers defend them. Traders remember prior peaks and assume history will repeat. But when price blasts through those ceilings and holds above them, it tells you something very important. The sellers are exhausted, the weak hands are out, the supply that kept the lid on the market has been absorbed, and once that lid is removed, you don't get a slow crawl higher, you get expansion, momentum feeds on itself, breakouts attract attention, attention attracts capital, capital fuels price acceleration. What makes this move different from the false starts of the past is the backdrop. Silver isn't rallying in isolation. It's moving in an environment where confidence in fiat currency is quietly eroding. Governments continue to spend money they don't have. Central banks talk tough about inflation, but structurally they are trapped. The global economy is built on debt, and debt requires low real interest rates to survive. That means currency debasement isn't an accident, it's policy. In that kind of system, hard assets don't just perform, they reprick. Look at the character of the move. We're seeing higher highs and higher lows. Dips are being bought aggressively. Pullbacks are shallow and short-lived. That's institutional participation. That's long-term capital reallocating. When silver starts outperforming other metals, particularly gold, it signals a shift from defensive positioning to aggressive accumulation. Historically, silver tends to lag in the early stages of a precious metals bull market, but once it wakes up, it doesn't whisper, it roars. And here's the part most investors still don't understand. Silver is not just a monetary metal. It sits at the crossroads of monetary demand and industrial necessity. It's embedded in solar panels, electronics, electric vehicles, medical technology, industries that are expanding, not contracting. Supply, on the other hand, is not responding with the same elasticity. Mining output doesn't just double because price ticks up. It takes years of exploration permitting development. When demand surges faster than supply can react, the only variable left to adjust is price. Momentum markets have a psychological component that cannot be overstated. Once investors who ignored silver begin to see it hitting multi-year highs, curiosity turns into fear of missing out. Portfolio managers who underweigh the sector start to chase performance. Short sellers scramble to cover. Each incremental move higher forces someone to reconsider their positioning. That reconsideration becomes buying pressure, and buying pressure in a thin market like silver can move price dramatically. We've also seen a narrowing in the gold to silver ratio, and historically that compression has coincided with powerful phases of silver outperformance. When the ratio begins to fall decisively, it tells you silver is not merely participating, it's leading. Leadership matters in any bull market. The asset that leads early often delivers the most explosive gains as the cycle matures. Critics will say it's overbought. They'll point to short-term technical oscillators. They'll warn of pullbacks. Of course, there will be pullbacks. Markets do not move in straight lines, but strong markets correct through time more than price. They consolidate sideways, shake out late entrants, and then continue higher. The broader structure remains intact. The breakout has already occurred. The burden of proof has shifted from the bulls to the bears. And let's talk about positioning. For years, mainstream portfolios were heavily concentrated in equities and bonds, assets directly dependent on central bank policy and economic stability. Very little allocation went into tangible stores of value. As cracks appear in overvalued equity markets and real yields remain negative when adjusted for persistent inflation, diversification into hard assets becomes not just prudent but necessary. Even a modest reallocation of global capital into silver would have an outsized impact on price due to the market's relatively small size. What we are witnessing is the early phase of a re-rating. Investors are beginning to question assumptions they took for granted: that inflation would always return to target, that central banks could engineer soft landings indefinitely, that fiat currencies are stable by default. When those assumptions weaken, Demand for monetary metals strengthens. Silver is benefiting from both monetary anxiety and industrial expansion. That dual engine creates torque. The breakout is not the end of the story, it's the beginning. Once markets clear major resistance, they often enter what technicians call a price discovery phase. There are no recent historical ceilings to act as roadblocks. Momentum algorithms trigger, trend followers pile in. Sentiment shifts from skepticism to optimism and eventually to euphoria. We are nowhere near euphoria. In fact, much of the public remains disengaged. That's how you know the move still has room to run. This isn't about chasing a quick spike. It's about recognizing a structural inflection point. Silver has absorbed years of selling pressure, consolidated through multiple cycles, and now it has broken free with strength. Momentum is not fading, it's building. And when you combine technical breakout, macro tailwinds, tightening supply dynamics, and shifting investor psychology, you don't get a temporary rally. You get the foundation of a sustained bull market. The market is sending a signal. The question is whether investors are willing to listen or whether they'll wait until the move is so obvious that the easy gains are already gone. If you want to understand why silver is rallying, you have to step back and look at the bigger picture. Markets don't move in isolation. They move because the underlying economic foundation is shifting. And right now, that foundation is cracking. What we're witnessing is the consequence of years of reckless monetary policy, chronic deficit spending, and a global financial system built entirely on leverage. Silver isn't rising because of hype. It's rising because the purchasing power of paper money is falling. For over a decade, central banks conditioned investors to believe that they could print unlimited amounts of money without consequence. Every time markets stumbled, more liquidity was injected. Interest rates were pushed to zero. And in some parts of the world, below zero, asset prices soared, not because of organic economic growth, but because of artificially cheap money. When you expand the money supply faster than the production of real goods and services, you don't create wealth, you dilute currency. That dilution eventually shows up in the prices of tangible assets. Inflation isn't just a temporary spike caused by supply chain disruptions. It's the natural result of monetary expansion colliding with economic reality. Governments are running deficits that would have been unthinkable a generation ago. These deficits are not cyclical, they're structural. Entitlement obligations, military spending, infrastructure promises, they're all financed through borrowing. And who ultimately finances that borrowing? Central banks. When debt reaches levels that cannot realistically be repaid through taxation, monetization becomes the default solution. That's where silver enters the equation. It has served as money for thousands of years, not because governments decreed it so, but because markets chose it. It cannot be printed. It cannot be conjured into existence with a keystroke. In an era where confidence in fiat currencies quietly iridesces, investors seek something real, something outside the banking system. Silver becomes not just a commodity, but a hedge against systemic risk. Real interest rates tell the story. Even when nominal rates rise, they often fail to keep pace with true inflation. If inflation is running higher than the yield on savings, you're losing purchasing power every single year. That's confiscation through monetary policy. In that environment, holding cash becomes a guaranteed loss over time. Capital flows toward assets that can preserve value. Precious metals historically perform best when real yields are negative, and we are structurally positioned for that condition to persist. There's also the geopolitical dimension. The global financial system is heavily dependent on the dominance of the US dollar, but that dominance is increasingly being questioned. Sanctions, trade disputes, currency weaponization, these factors encourage other nations to diversify away from dollar reserves. Central banks around the world have been accumulating gold at a historic pace. While silver doesn't always receive the same official attention, private investors and institutions recognize that monetary metals move together when confidence in fiat declines. Energy transition policies are another macro driver. Governments are pushing aggressively toward electrification and renewable energy, solar panels, electric grids, battery technologies. All of these rely heavily on silver due to its superior conductivity. This isn't speculative demand, it's structural demand embedded in industrial policy. As governments subsidize green initiatives, they indirectly stimulate silver consumption. Unlike paper assets, which can be diluted indefinitely, the supply of physical silver is constrained by mining output and geological reality. Debt levels across the globe are not just high, they're unprecedented. Corporate debt, sovereign debt, consumer debt, all sitting near record levels relative to GDP. High debt makes economies fragile. It limits the ability of central banks to normalize policy without triggering recession or financial instability. That creates a trap. If they tighten too aggressively, markets break. If they ease too quickly, inflation accelerates. In both scenarios, confidence in currency weakens. Silver thrives in uncertainty. There's also the credibility factor. For years, policymakers insist that inflation was transitory. That narrative collapsed as price pressures persisted. When public trust in monetary authorities declines, markets adjust accordingly, inflation expectations become embedded, wage demands rise, long-term contracts factor in higher costs. Once that psychology takes hold, it's extremely difficult to reverse without severe economic pain. Investors anticipate this dynamic and position themselves in assets that historically outperform during prolonged inflationary cycles. Liquidity cycles play a crucial role as well. Even when central banks attempt tightening, financial stress often forces them to pivot. Markets have become addicted to liquidity. Each time volatility spikes or credit markets strain, policymakers respond. That pattern conditions investors to expect currency debasement as the ultimate solution to every crisis. Over time, that expectation alone becomes bullish for hard assets. Silver's rally is not just a reaction to today's headlines. It's a forward-looking response to structural imbalances. Currency supply continues to expand, fiscal discipline remains absent, real yields struggle to compensate for inflation, industrial demand strengthens, geopolitical tensions increase. All of these forces converge into a powerful macro tailwind. And here's what many overlook. The silver market is relatively small compared to global equity and bond markets. It doesn't require a massive capital shift to produce significant price appreciation. Even a modest relocation of institutional portfolios toward precious metals can create disproportionate upward pressure. When macro uncertainty rises, diversification becomes mandatory, not optional. The rally is being fueled by a growing recognition that the current monetary system is unstable in its present form. Whether the adjustment comes through inflation, currency devaluation, or financial repression, the end result is the same paper assets lose purchasing power relative to real assets. Silver stands at the intersection of monetary protection and industrial necessity. That combination gives it resilience and leverage in an environment defined by debt, inflation, and policy miscalculation. This is not a short-term trade driven by speculative frenzy. It is a macro-driven revaluation process. The forces behind it are deep, structural, and persistent. As long as governments continue spending beyond their means and central banks continue enabling that behavior, the fundamental case remains intact. Silver is not just rising because investors want it to. It's rising because the global monetary framework demands it. When you talk about long-term upside in silver, you have to strip away the short-term noise. Forget the daily fluctuations. Forget the pullbacks that financial media loves to dramatize. What matters is where this metal sits in the grand scheme of global finance. And more importantly, where it's headed as structural imbalances unwind. Silver is not expensive. In fact, when you measure it against currency debasement, asset bubbles, and historical valuation metrics, it's still dramatically undervalued. Start with its historical relationship to gold. For centuries, markets maintained a relatively stable ratio between the two metals. That ratio is blown out in modern times, largely because paper markets, derivatives, and speculative flows distorted price discovery. But distortions don't last forever. When the gold to silver ratio begins reverting toward its long-term average, silver doesn't inch higher. It accelerates because it's a smaller market. It moves with greater volatility and far more upside torque. A modest shift in capital flows can produce exponential price appreciation. Now layer on top of that the expansion of the global money supply over the past 2 decades. Central banks have created trillions in new currency units. That expansion didn't reverse it compounding. And during so-called tightening cycles, balance sheets remain bloated by historical standards. Currency creation is cumulative. Once money enters the system, it doesn't disappear. It circulates over time. That persistent expansion irradiates purchasing power. If silver merely keeps pace with the decline in fiat value, its nominal price must rise substantially from here. If it overshoots, as hard assets often do during currency crisis, triple digits aren't extreme, they're logical, then consider supply dynamics. Silver is primarily mined as a byproduct of other metals like copper, lead, and zinc. That means its production isn't purely responsive to its own price. Even if silver surges, miners can't instantly ramp up output unless the primary metals they're extracting are also in high demand. This creates a structural rigidity on the supply side. Meanwhile, industrial demand continues to grow, particularly in solar energy, advanced electronics, and medical applications. You have a tightening physical market intersecting with expanding monetary demand. That's a powerful combination. Investor allocation remains astonishingly low. Look at global pension funds, sovereign wealth funds, and institutional portfolios. The percentage allocated to precious metals is tiny compared to equities and bonds. For decades, investors were conditioned to believe that stocks always go up and bonds are safe, but bonds lose value in inflationary environments, and equities become vulnerable when profit margins compress under rising costs. If even a small percentage of global financial assets rotates into silver, the price impact would be disproportionate. The market simply isn't deep enough to absorb large capital inflows without repricing significantly higher. There's also the psychology of late cycle markets. We've lived through one of the largest asset bubbles in history, fueled by cheap money and speculative excess. As those bubbles deflate, capital seeks safety. Historically, hard assets become the refuge. When paper wealth evaporates, silver benefits not only from fear but from opportunity. It's accessible. It's affordable compared to gold. It offers both monetary protection and industrial leverage. That dual appeal broadens its investor base during periods of uncertainty. Real interest rates remain a critical factor. Even if nominal rates appear elevated, persistent inflation keeps real yields compressed or negative. Negative real yields punish savers and reward borrowers. In that environment, holding cash becomes unattractive. Investors search for stores of value that cannot be diluted. Silver fits that description. If central banks attempt to crush inflation by dramatically hiking rates, they risk destabilizing over-leveraged economies. The political appetite for that level of austerity is minimal. More likely, policymakers tolerate higher inflation. That tolerance is bullish for precious metals. Another overlooked element is above-ground inventory. Unlike paper contracts, physical silver must exist to be delivered. Industrial consumption permanently removes a portion of supply from investment circulation. As inventories tighten, price sensitivity increases. A small surge in investment demand constrains available supply, leading to sharp upward repricing. Markets that trade heavily on leverage can remain suppressed for periods of time, but physical shortages eventually force alignment between paper and reality. Technological expansion adds fuel to the long-term thesis. Electrification trends are accelerating globally. Renewable infrastructure requires significant amounts of silver due to its unmatched conductivity. As emerging markets industrialize and to develop nations modernize grids, structural demand expands. This isn't cyclical demand tied to consumer sentiment. It's embedded in infrastructure transformation over the next decade. That demand profile alone supports higher equilibrium pricing. Now, combined monetary debasement, constrained supply, industrial growth, under allocation in portfolios, negative real yields, and tightening inventories. Individually, each factor supports higher prices. Together, they create a compounding effect. Markets move in cycles, but secular bull markets and hard assets tend to last years, not months. They begin quietly, build steadily, and culminate in phases of rapid repricing when mainstream participation finally arrives. The notion of silver reaching triple digits sounds dramatic, only because investors are anchored to recent price ranges. Anchoring is a psychological bias. If currency purchasing power continues declining at its current trajectory, what seems extreme today becomes conservative tomorrow. Nominal price targets must be evaluated in the context of monetary expansion. When viewed through that lens, substantial upside isn't speculation, it's arithmetic. The long-term upside potential in silver is not rooted in hype. It's grounded in structural imbalances that have been building for decades. Debt levels are unsustainable. Monetary discipline is absent. Industrial demand is expanding. Supply growth is constrained. Investor exposure is minimal. These are the ingredients for a sustained bull market. And here's the critical point. Secular moves rarely offer repeated opportunities at the early stage pricing levels. By the time consensus recognizes the shift, the majority of gains are already behind us. Silver remains far below inflation-adjusted historical highs. It remains under-owned. It remains underestimated. That combination is precisely what creates asymmetric opportunity. Long-term, the trajectory is not determined by short-term volatility, but by fundamental reality. And fundamental reality is clear. Paper promises multiply endlessly. Physical silver does not. When that distinction becomes fully appreciated across global markets, the repricing will not be subtle. The era of cheap money is over. The era of fiat dominance is unraveling before our eyes. And in its place, something far more enduring is emerging, a renewed recognition of real wealth. Silver has begun its ascent not toward modest gains, but toward triple-digit territory and beyond. What you do with that information today will determine your financial landscape tomorrow. Don't let opportunity whisper past you. Grab it, stack it, own it. Because in the world of sound money, the future belongs to those who prepare today.